Okay, well, good morning, everyone, and greetings from West Virginia. The subject we're going to talk today is to really talk about how do we fix the costing problems. What we've done in the previous three sessions is kind of giving you all the underpinnings of how the system works. Now what we want to do is pull this together, and then I want to share with you my experiences in this area because I've been called out any number of times, and there's two things that are the most common things that people are having problems with on an ongoing basis. One is costing, the second is inventory. I've made a pretty good living going out and fixing those types of problems. I want to share some of those experiences with you. Okay, for those that's been in the previous three sessions, you're probably tired of me talking about it, but I'm Don Riggs. I was honored early in 2016 or 2017, rather, by being selected a Microsoft MVP. I'm very honored by that. I was just like I've told people, I'm just glad they didn't award it to me posthumously because I'm pretty late in my career. I'm using my time to really help mentor and develop young talent within this industry. 30 years plus consulting experience. I've been more on the implementation side, so we call it the after sales side when we really actually try to accomplish what the salespeople promise. I've got over 15 years of AX experience. Been involved with a number of ERP implementation. It's a wonderful career too. A team building and an ERP implementation and the feeling of getting that people up and improving their business is a really great feeling. American Production Inventory Control Society, I certified in the early 80s. That's the body of knowledge for master planning, shop floor control, all those types of things. There's all the theory behind that. And anybody who is looking to be a manufacturing or know more about manufacturing should look at APICS, APICS. I've helped design ERP systems. Another thing I'm very proud of, I've had a number of articles published in MS Dynamics World, and also AXUG magazine has published a couple of my articles too. But I would encourage you to go out and take a look. I've published 3 articles recently, and one of the articles is about mentoring, to create experts in the industry. I would encourage you to take a read on that. You have to join, but it's a free type of membership. And then effectively, I've been working on costing and costing processes for most of my career, and even helped design costing systems. Okay, so here's what we're going to talk about. I probably have hammered this one to death, but we're going to go back through and talk about plan cost. Now, what's interesting is, well, it may not be interesting, but I'll share with you anyway. People think that standard cost is a high maintenance type of activity, and that's why they tend to lean towards going to other costing methods many times. There's other reasons why you would tend to go with a different costing method. One is if you're not a manufacturer. When you're with manufacturing, you're more likely to use standard cost than another costing method. But I want to suggest to you that most of the things we're going through today are about other costing methods than standard. And let me illustrate what I'm saying. Standard cost shows its errors in variance. So what you're doing there is managing variance. These other costing methods many times have more possibilities of these things occurring as a problem. Now, clearly, the difference in standard cost is you're going to get a $10,000 variance. You still have to manage and improve your costing in your costing execution based on that variance, but you're looking at variance primarily. It's really many times the other costing methods have actually more maintenance to it, than standard. So I thought that was interesting. I was just reflecting on that this morning. Then we want to talk about improper setups. We're going to talk about ledger not matching to your physical inventory. How do those things occur? Why do they occur? And what you need to look at to keep them from occurring. Then we're going to talk about how do you fix a broken costing system. We're going to talk about what do? I know I've got the problem. What do I need to fix it? And what I'm going to suggest to you is like anything else, you prioritize what's important. And I'm going to suggest to you always, the single most important with any system to work correctly, whether it's in planning, whether it's in inventory, whether it's costing, is accuracy and timeliness of transactions. Single biggest problem. Because if it's not right in the first place, you got to fix it someplace down the road. And like we always say, that any mistake anybody makes ends up in the ledger. So really we want to try to fix our process more so than anything else. Then next we're going to talk about how do we avoid the common mistakes. In other words, how do we shore up our system and let me illustrate what I'm talking about. I don't know how many times I've been out to a place that has a problem. We fix it, but they never fix the source of the problem. So the next time it happens, it's broken again. Think about if you can fix it at the source, you're going to save yourself 6 times the work downstream. So in other words, any mistake usually costs you 5 times more to fix it. So it's all you keep that in mind. Focus on getting the stuff right in the first place. Get it set up right. Be a student of this system and spend time on fixing the problems that cause recurring problems. And then lastly, we're going to talk about the importance of financial oversight on manufactured items. I'm going to suggest to you many companies do not necessarily have someone designated as a cost accountant. We need at least somebody that acts as the cost accountant. It's very important for things like identifying profitability, fixing these problems. Somebody has to own that, no matter what the title is. And just because you're in accounting doesn't mean you're a cost accountant. And just because you're in production or in some manner of production engineering doesn't mean that you should not or cannot understand the costing system to avoid the mistakes. So that's kind of what I'm saying, and that's why I'm saying you need to have somebody that oversees that to make sure you're transacting accurately. Otherwise, quite frankly, what's the point? Okay, the reasons why, and I won't spend as much time on this because we've kind of beat this one a lot, but I want to, part of this ending session is to tie everything together, okay? Actual costing systems, you have a plan cost. Why? Again, as we saw before, and we'll probably see again here shortly, if there's no inventory, there's no cost. Therefore, the system uses planned cost in absence of an inventory value that's predicated on inventory. So if you have no inventory, you have no inventory costs. So we'll use planned cost at that point, okay? Planned cost allows you to look at transactions that operate outside of that planned cost. So therefore, if you get something that is you're transacted at 0 cost, or let's say some percentage different than planned cost, that's an indication that the planned cost needs to be revisited, or that transaction was done improperly. And what I like to illustrate is that in a standard cost system, if you get a $10,000 variance, somebody's going to look at it. In an actual costing system, a $10,000 mistake is not readily available unless you compare that against some kind of standard. The other factor that plan cost is used in cost roll-up. So if you have no plan cost, the cost roll-up may be inaccurate. So now your costs at your finished goods or value-added product level does not have the proper either standard cost or plan cost. And by the way, that factor is the same in standard cost. If you don't have a cost at the child level, and keep in mind, you could have different costing methods for different types of products. I've seen it, it works fairly nicely, but you've got to respect the fact that you have to have a cost that can be reflected in the roll-up whether or not you have inventory. By the way, it's not true with standard cost. It's still standard cost is that. It always knows what the cost is. It just needs, so when you roll up, it'll pick up the standard cost unless there is no standard cost. Also, you think about it at your beginning of the year when you're looking at profitability, you're projecting a margin that you should have. So let's say we're projecting we're going to grow sales by 30%. Well, therefore, you're going to have an associated cost of goods sold. They're based on some manner of standard. And what we're suggesting is that whatever your business plan is, you should have supporting structures that reflect what your assumption of cost is at the item level. That's all I'm really saying. Plan cost provides for that. And then it'll also then create less adjustments because, again, it will sometimes use plan cost, you know, in place of the actual, in place of some actual types of situations. We're going to show you some examples of that too, by the way. All right, let's move on to the next slide. Problems with no plan cost. And we've covered some of this, but we're going to start out as we have 20 on hand at a value of $10.83 each. Okay, 20, cost price of $10.83. We cycle count all 20 out. By the way, it shows the zero shows up as a blank. You can see that you're going to adjust to minus 20. That's how you know. So I'm cycle counting all 20 out. Now I cycle count all 20 back in. Here's the results if I have no plan cost. So what's important to note is that, again, in cycle count, it does the physical and financial transactions at the same time. But without a plan cost, when I have no inventory, the cost is zero. So therefore, having a plan cost would pick up the cost price. So again, that's one of the reasons why we have a plan cost. And then that creates an on-hand inventory at no cost, as we saw. So we sell 5, no cost of goods sold. So that gives you an idea on how and why that's important. And also why it's important to try to catch it in the beginning. In other words, be responsible for your transactions you do and try to understand what the impact is. Okay, let's talk about, here's another big problem. I've seen time after time in many companies where they'll put a purchase order out there where they don't know the cost, and then they'll transact against that. And that causes a big problem also. So here's a problem with no PO price. Okay, we have no unit price here. Unit price is 0. So the purchase order was entered with no unit price. The purchase order was received at no unit price. A sales order shipped at a cost of 16. Why? Because there was no inventory. It used the planned cost. All right, or it used the planned cost is what the illustration is here. Well, let me go back to previous. So it transacted at 0 cost, but it used, depending on how I'm doing my valuation. What I did is shipped, and it actually transacted at planned cost on the sales order shipment. So it gets it from planned cost. So here's your where it got it was from the cost in the item master is where it got it from. Here's your resulting inventory transactions. You've got 10 that has no physical cost. You've got one that has $16 of physical cost. Think about what this is saying. It's saying we have 9 items remaining at no cost. And what we're going to illustrate here is the problems it causes you in things like inventory value reports and some of these examples. Because that's the other thing. I don't know how many people seen an inventory value report where you had an inventory value with no quantities. Some of the things I'm going to show you through these sets is give you some visibility as to why that happens. I'm not sure it's exactly this example, but I think you're going to see in some of the examples I'm doing is that I want to also tie this to why you see the things in inventory value reports you see, and it's based on incomplete, improperly processed transaction sets that can only be fixed through the inventory close process is what I'm trying to illustrate here. And that means you have to have financial inventory on both sides. Otherwise, it doesn't know. So in other words, if for some reason I never posted a vendor invoice on this product, this particular purchase orders, and I've seen it, I don't know how that could happen, but I've seen it happen. This will be this way forever until somebody goes in and posts the vendor invoice on the purchase order. So going now to the next level, this is what your on hand now looks like. You've got 24, but a physical value of minus 16. And we had some inventory before that purchase order. Here's what your inventory value report looks like. You've got 24, but an inventory value of minus $16 is what the value of that is. And the reason why it does that is it's showing $16 going out. There was no inventory value in the first place, so that makes an inventory value of minus $16. Now let's go a little bit further down the road. We're going to now cycle count, so there's no inventory. So we're going to cycle count our inventory out. That means we're going to end up with 0 inventory. But now we have 0 inventory at a physical cost of minus 16, a financial cost of minus 384. The reason why? When we counted it out, it picked up the planned cost of $16 each. So you see now how this is escalating with our process that really creates all kinds of problems downstream for us. Here's what our inventory value report looks now. And these are transactions I went through to illustrate these problems. So if you look at it, now we have 0 inventory with an inventory amount of minus 400. So we have an inventory value with no quantity. So again, when you see these things out there and wonder why, this is why. So now let's continue one step further in the process. Now I invoice the one item. Okay, I had the sales order. This is was showing pre-invoice. It was still the physical. Now I'm sales order invoicing the one item. What that does is it gets rid of the physical cost amount and makes the whole thing now a financial inventory cost amount. And let's just illustrate. See, it was 384 in 16 before. Now, since I financially settled this side, it really just moved it down to here. Because remember, we started with the inventory when we received it had no physical value, but it had a plan cost of 16. But remember, keep in mind, the purchase order's going to take the purchase price. That's why it's so critical to have a purchase price in there, is what I'm illustrating. So now when I look at your physical inventory report, again, I still have a value of negative, because what I've got is this set up to add physical and financial together. So that's why it stayed at minus 400. So I have minus 400 inventory value with no inventory. Now I come along and invoice the purchase order. Okay, and what that said is I really received 10 at 17, not 0. So I posted those with a cost amount of 180. Keep in mind that the sooner within the same period we can get the sales order invoice and purchase order invoice, or whatever the downstream issue of that within the same period, we reduce our problems. But also keep in mind, this was all done before we did anything on the inventory close or recalculation. So all these things, these transactions are occurring at different times before we're financially posted. So that reduces this down to 219, and I'm pretty sure if you take the 183, whatever it was, and subtract it from 400, you're going to end up with 219. Okay? So now we look at the transactions. This one we had a cost amount of 180. We sold 5 at no cost amount. Or no, it was up here. We sold 1 at $16. This one was from before. 1 at $16. So what the result is we now get an inventory value report that's $219.37. The 183 minus the 400. Still, no inventory balance. So going back, what kicked this all off was having a 0 purchase price. Again, having a 0 purchase price. So you should always have a purchase price. So now we go one step further. Now we're going to do our recalculation. So now what we're going to do is we're going to do a recalculation, because I really wanted to illustrate with you why the timing of your recalculation, accuracy of your inventory accounts, and making sure you try to do this all in the same period, because this now, the recalculation is the process that goes through and looks at these mismatches and say, okay, I've got this physical transaction here that the financial transaction differed from. What was sold against it, or what was the outbound or the issue against that inventory lot, because I need to do something with the difference in the financial value after the fact. So I'm going to go ahead and do the recalculation. What that does is does a recalculation of the settlements. Now, if you added these numbers together, do you have any idea what that number would be? And Julie, I can't see if anybody's asking a question or answering the question, so.
No, we do not have any answers. Folks,
Okay.
got one.
What is it?
Guess, put it in the question box. No one's guessing.
Okay. Well, if you go back to here, to 1937, if you add those numbers up, I'm pretty sure you'll come up with 1937. So what I'm trying to say to you is that it's going to fix this. Because what this is telling you, that I have $219.37 that has not properly been accounted for, and is based on the differences on when things happened. So if we take this adjustment, this will add up to 219, and these are adjustments we're making to these particular transactions. We're going to do this on accounting journal, we're going to do this on a sales order, that offset on a sales order, and this against accounting journal. Regarding these transactions, which you can see the difference between your physical cost and your financial cost here. And I should have shown the adjustment here. I apologize for that. Some of these slides I obviously redid, I missed that, but normally I would show the settle amount or adjustment amount more appropriately. But we're saying this transaction was 384, physically now got posted at 190. So there was adjustment between these different costing structures. Now the inventory value looks like it's supposed to. No inventory, no inventory amount. I can't tell you how many times I have seen this situation with people having no idea what to do with it. I'm not saying sometimes there was a bug early on where this situation could occur. Now, because of that, they basically did not allow inventory to go negative. I just want you to know, I'm talking about physically negative. I'm going to tell you from my experience and the testing I've done, that's no longer an issue, but not allowing to get the inventory go negative most of the time is not a bad idea. There are times, though, when you need to consider inventory going negative, particularly when you're dealing with, let's say, a third-party warehouse or a situation where you own inventory managed on a customer site. Without going into great detail, anytime you have a warehouse that you do not have 100% control of the transactions, sometimes it's not a bad idea to let those items go negative, because if they said they sold it, you still want to sell it and process that transaction, but you do want to do a reconciliation periodically to get your inventory correct at those remote locations. But generally, I can't think of anything more vivid to tell you how these things look when you do things and when you run the reports, by the way, without doing an inventory close. Generally, if you see these kind of things after an inventory close, the most likely problem is you have some inventory condition that has not been able to be financially settled. That's the most likely source of problems. Okay, this would be a good time. Any questions on what we just covered?
Nothing in the queue right now. Oh, one just came in.
Okay.
Have you run into situations where the inventory value report is completely out of sync with inventory transactions? That is, the total cost values of the inventory transactions do not add up to the ending balance.
Yes, because if you took these or the ones before, depends on how you're adding them up, by the way. But this is reflective of the transactions. Now, there were some bugs where they could go out of balance, but I have always been able to figure out based on the transactions what that value report is. But remember, though, you've got to have all the transaction sets involved. So I'm not sure exactly what the questions are, but if you're saying if you print the transactions out within that and they don't add up, my guess there is there's something that is different between what's being added. Because remember, when we're looking at inventory value, we're looking at transactions that could have occurred in the previous period that have not been closed yet. Those are going to be taken into account. All I'm trying to say there is to figure it out is going to be a big problem, and there's no easy solution, because if you really look at it, when you look at what's that's in that inventory and what is residual left in that inventory, it in theory could have come from any period that has not been fully closed.
That question came from Michael, and he just followed up with, he's just wondering how AX arrives at the ending balance per product.
Oh, okay. How it arrives at the ending balance?
Per product.
It pretty much there's an invent sum table. And just so you know that the invent sum table is what they're using a lot of times to arrive at these ending conditions. That table can get out of balance with the transactions, but most likely, it has to do with the transaction that is outside the group of transactions you're looking at. And the only way to do that would be to look at transactions from the beginning of the time that are still open. So I'm saying it's not a simple problem. As much as I've worked on it, it doesn't make it a simple problem. So that's why I'm talking about what do we want to do about it? How do we go ahead and fix it? And one of the things you've got to do is read the reports that says, what do I have open out there that's not going to be closed during this period? That is vital to try to find a way to fix that. Now, once you fix all those, you now have a much more reliable set of information to look at, because you're not trying to account for something that occurred 2 years ago. And really, it's still out there. And it's reflected as inventory value from 2 years ago if you don't close it. You don't do something about it. Okay?
Thank you. That's all we've
okay.
got so far. You can go ahead.
Yeah, like I said, I'm going to suggest to you that there are a lot of mysteries out there when it comes to these things. But the more I've worked with it, the more I understand that most of the mysteries come from something that happened a long time ago that we didn't complete. So when we usually are working on problems, we're working on a problem within a certain time frame or within a certain context. I'm going to suggest to you that if you take what you think the value is and you multiply all the quantities times that value, that doesn't necessarily you're going to have the same numbers in the ledger or the same numbers in this report. It is because of these outliers we're talking about, which are important to get fixed. Okay?
Sounds good.
Okay, now we're going to, so again, the idea is to keep it from happening, right? It's kind of the idea. So that's what we're really going to talk. We're going to talk more about prevention. We're going to talk about what we do to fix it, but also the most important thing is to prevent it from happening. So if you want a good, healthy costing system, you're going to fix what's wrong and then strive to improve your process is kind of the idea. Because if you fix what's wrong without improving the process, you're not accomplishing anything. Because you're just going to have the same problems is what it pulls. They may not be quite as bad, but you're going to have the same problems. So if you've got purchase orders, sales orders, transfer orders, production orders that are sitting out there and been sitting out there for years, partially completed, you've got a mess. So the first thing you have to do is go out and close those, and you're going to have to take your hit this period. Otherwise, your system will never be right. All right?
And Don, we have another related question.
Sure.
Does the recalculation of inventory value get affected if you perform the close in a backdated AX session?
Well, first thing, you can't, well, let's talk about, first off, let's define what backdated is. You cannot do an inventory close that is previous to an existing inventory close, if that makes sense. In other words, if I've got an inventory close for this month, I can't go back unless I cancel the current transaction. Now, here's how recalculation works. Recalculation is today. I want to stress that, or I think you can define the time frame, but pretty much recalculation is today. So a lot of people get confused in the relationship between the close and the recalculation. Here's really how it works. Recalculation you can run anytime. And one of the advantages of recalculation, you can do it on a subset of items. That's one advantage to recalculation. Like I can recalculate just one item. When I do a close, that says anything before the close, I'm going to look at closing. But when I say do that in conjunction with the recalculation, it will get rid of any recalculation that occurred after that close and recalculate. Again, I want to go over that. When I do a close and I say recalculate always deletes the recalculations that occurred before. So in effect, if I recalculate my whole inventory every day, I truly am more or less canceling out the recalculation for yesterday and recalculate everything for this day. That's why the only reason I do that, simpler. It's simpler. And also there's no guarantee that the recalculation yesterday didn't have something changed in today, but rather than do a net change, in other words, just add another one, it kind of does it and puts it, does it and puts it back. That's why the inventory close is so important within this situation, because it says don't go backwards, with the exception is remember that any transaction that is not fully closed in a previous period, no matter how far back, is subject to that recalculation based on something changing in the current period. Again, I hope that makes sense, but anything, in other words, that's not financially closed, and that means quantity on one end on the receipt is reconciled to the quantity on the issue, it is reconsidered every time. So 5 years later, if I went back and put the vendor invoice now against that purchase order from 5 years ago, that recalculation would make that adjustment in this period. That's why you want to try to close everything in the period you possibly can. And also why you want to transact and have good standards of planned cost. In other words, if you have a good standard of planned cost, you'll have less transactions. What I look at, and we're going to cover this a little bit later, I look at adjustments. And I can tell you just by looking at settlements, adjustments and settlements are the same thing. Just by looking at settlements, I can tell you how well you're using your system. Okay, so again, let's go back to the production order considerations now. What's important is that the production order uses an estimated cost when your report is finished. So what that means is it's going to take your current BOM, current routing, do a roll-up, and say, this is my estimated cost, and I'm going to use an estimated cost for report is finished. And what I'm really illustrating here is that when you think of the conditions, like when we report is finished, we can sell that inventory. All we're really saying here is the same conditions exist between that and a purchase order sales order combination. Is the same with production order sales order combination or transfer order or any number of issue types of transactions. The key is, though, is you have more control over your production orders, or hopefully you have more control over your production orders. So in theory, long-running production orders are something that you should not have. There are times when you have to have them, but generally, a production order at a maximum should only exist during one period. Ideally, it should only exist for about 1 week. Again, depending on what you're building. Depending on what you're building. Okay? But when you consider these things, the only difference between standard cost and any other cost method is that if you have big swings in variance, you got the same problems. Your standard costs are not good. You're probably not transacting correctly. You've zero purchase orders, poor standards. Keep in mind, too, that standard cost was something that was rolled up at some point in time. The estimated cost is based on current roll-up. The more closely those are together, the less settlements you're going to have. That's what the key is. So one of the things you can manage your system for is by looking at the value of your settlements. Because that's what, again, the bigger the settlements, the less accurate, the more you can have things posting in other periods. And really, it's just an indication of poor cost planning and execution. Okay, now I want to cover improper setups because that's another factor. And really what we're talking about is how do we have situations that create inventory to go out of balance with your ledger? Because this system, if you get them in tune, the two, and you have your setups 100% right, should track. But here's the problem. Many people have setups that are just wrong. And what that means is even if you fix them, and let's say you adjusted the ledger value for the inventory to match up to your inventory value report or some other vehicle, you may continue to go out of balance because you haven't fixed the problem at the source. So here's one of the most common things, okay? Service items and non-inventory items pointed to inventory. Should never happen. A service item or a non-inventory item should be posted against an expense. In other words, it's expended at the point of receipt. If you point it to inventory, you're going to increase the inventory value with no quantity in the inventory to represent that. In other words, inventory value report is forced out of balance with your service items because there's no reflection in the inventory. Because a service item by its nature doesn't create an inventory. Another one I've seen any number of times is when you moved over from the old system and you took the balances from the old system, it wasn't in balance. So try to, and again, I'm saying you could have this problem. The reason I bring it up now, I'm probably pretty sure most of you are currently in an implementation. But if your inventory balance was out of balance coming in, it's going to be out of balance going forward. So you really want to make sure you started with the right numbers. So technically or execution-wise, what you'll typically do is you'll bring the inventory over, you'll post that in the previous period, you'll reduce, what you're going to do is then look at the physical, the inventory value in the old system. You're going to use the inventory value in the new system, brought over from the old system. Then you'll do the valuation report, identify how much your inventory is out of balance, and make adjustments in the next period. Because there's no guarantee when you put all these pieces together, you're going to end up with the same exact numbers both places. So do your, and so many times what I'm trying to suggest is that the adjustment in the initial part of the system was done wrong. At some point in time, you have to reconcile that through some inner adjustment, okay? Understand and validate your item groups and also the posting. What controls what hits the ledger primarily is your item groups. And then your posting profiles the other, because that is a superset of the item groups. Also try to limit your inventory posting to item groups wherever possible. Don't look for two places for the same thing. This is kind of a let me explain what I'm trying to say here. Oh, what I think I'm trying to say here. So when I'm saying avoid duplicates with duplicate meetings and set up inventory to assist in reconciliation, think about your inventory accounts and segment those. Don't have just one inventory account. Okay, have a raw materials, have a semi-finished goods, have a finished goods, or some segregation of inventory that makes it easier to reconcile. The other thing, don't mix a inventory account that's not on the system with an inventory account that is on the system. And what I'm trying to illustrate there is you might be accounting for inventory from a separate division, let's say, or some reason you have a segregated inventory that isn't physically on the X system. Don't put those big two accounts together and make adjustments. In short, if you have an inventory account that is tied to inventory, unless you're making a temporary adjustment to bring your inventory in line with the physical inventory, you should never be able to post to that account except through inventory. You should never be able to hit it with a journal. So if you enable that to be hit with a journal or any other way other than through inventory, that's a mistake. And we're going to talk about that a little bit later. Plan cost, and again, what we're saying is that is your cost roll up in line with your true cost that you're transacting at this time. The bigger the variable there, the more settlement and adjustments you're going to have, because sometimes it uses plan cost to say what the cost should be before we do the physical aspect or the financial aspect of the costing structure. How are we doing on time? We're getting, let me look at this next slide and we can.
Yeah, we're getting close to having a break, so you just.
Okay, well, why don't we go ahead now, because I'm going to go in more detail. I mean, we can go through these. Let's go ahead and take the break now. This is not a bad point to take a break.
All right, sounds good. So we're 7 minutes to the hour. I think we'll get back together at 5 after. That gives you 12 minutes. Do whatever you need. So 5 after the hour, we will rejoin.
Yeah, let me just, before you come back, why don't you put something in comments or whatever we can see in questions. I want to know how this is going, if you feel it ties together what you've learned, if this is an effective way to learn, and am I properly presenting the information? Because these things, I can always change, and we can do better. The idea of this is for you, and it needs to be effective for you. I kind of know a little bit about it, so it's how effective do I translate what I've learned to you. And I always like feedback on that. And wherever you can, whoever can provide feedback, I would appreciate. Julie, does everybody have the access to be able to do a review of this?
Absolutely, they do. They get an email as soon as I close it that says, please provide feedback. So,
okay. They don't have to be an AXUG member to do that?
No, not at all. Mm-mm.
Okay, then I would encourage you all. Look, we're doing this for free. We're taking our time to do it. All I'm asking is give me feedback. That's not a small, that's not, and I know you're taking your time and that's valuable too, but give us feedback. That's how we get better. Okay?
All right.
Okay, thanks everybody. Have a good day.
We'll join at 5 after the hour. Hey, Don, it's Julie. Let me know when you're back.
Had to turn my microphone back on. Yeah, I'm back.
I just wanted to tell you, everybody can hear us, but I just wanted to tell you that I made you an organizer so you can now see the questions or the box.
Yeah, I'm trying to figure out how to open it big enough to see it.
Yeah, you can see the comments folks have been entering. So.
Okay, great.
And you can actually follow your own questions. So.
Okay, well, that might be more than well, let's see, how can I do see the questions answered. I'm having a little trouble with the,
So you're not seeing the entries people have made in the question?
I'm seeing them, but my window's too small, so it's a technical problem. Here we go. Here we go. Now I got it.
There you go.
I had I got quite a few questions today, huh?
Well, a lot of comments in there, which is why I made you an organizer, because I'm like,
sure,
you should just be able to read these. So There you go.
Okay.
Take your time. We'll start in a few minutes.
Okay. Okay. Well, great. Okay, I think I'm up to. Okay, so. Okay. Okay, let me know when we're ready to start again.
All right, I said 5 after the hour, so about 5 more minutes.
Oh, okay. Okay.
Hey, folks, we'll start in just a couple of minutes, so.
While we're waiting, and Carol, you had a fairly extensive question here. You can email me directly at donriggs@busproc.com. That is on the handout. And if you have a specific question, you can send me an email on it, and I can help possibly point you in the right direction. Okay?
She says, thanks, Don.
Yep, I can see it now.
Oh, yeah, that's right.
And thank you all for the kind words on that I am getting the materials to you effectively. You know, and keep in mind that this is a recording, so you can go back and reference it. And this probably won't be the only time we ever do this. And then we are talking on maybe an inventory series we could do, and I have some interesting news for you on something else that I'm hoping to do for you too, maybe later in the year, probably in the November timeframe. We're still talking about it, but I'll show you that. Okay.
All right. We're just, half a minute to start, but I think you're good to go.
Okay. Regarding the questions on the project management side, if that's something you're interested in, by the way, I do at AXUG, I'm doing a session on the project management setups. It's an introductory course, but it talks about the postings. So if you're going to be out there, I have sessions out there. I just put an article out at MS Dynamics World that talks about one of the sessions I'm going to be talking about and shows all the other sessions I'll be involved in. So you have any interest in attending that, I'd love to see you and come up and let me know you were at the webinar here. And lastly, I want to make a comment about the methods I use. I've done this a number of years, and a lot of people like to see demos, and I understand that. But the problem is that number one, when you have this in a PDF format, you have a structure that you can go to and look at. The other side of it is a demo consumes so much time. Just the mechanics of the demo, I can only get like 50% of the information to you that I can do by doing the screenshots and things like that. They're both effective learning opportunities, but I do it this way because, quite frankly, I can provide more information than I could ever do in demoing all of this. So for those of you that expect to see a demo, I'm sorry, but that's the reason why I do it that way. And I've done it a few times, so I'd like to think that this has proved to be a superior way to do it. In most of my presentations, you'll see are these. Now, we'll be doing other usually if I'm doing something where it's a demo, that's a recorded type session that I would do rather than a presentation. Okay, so let's continue now. Okay, we're going to talk about incorrect services in non-inventory setups, and I've talked about it in previous sessions, but let's now show you what this looks like. Okay, this item M0051 is firmware. It is a service item and has an item group of audio. That group is hitting an inventory account. So audio, when you assign that, and this happens all the time, people kind of have some accounts up there, so they just pick an item group. You should have item groups that are specifically for services and item groups that are specifically for inventory, is really what I'm trying to suggest here. So it's got the wrong item group on it. Now I go to post, and here's a purchase order receipt. You'll notice that I'm hitting the raw materials accounts in the purchase order receipts, and I'm hitting the finished goods inventory also on this. So in other words, you'll notice I'm hitting inventory accounts is what we're suggesting here. There's no on hand. Okay. What this means is I've now forced my inventory out of my ledger inventory out of balance with nothing, no quantities in inventory. So therefore, my inventory value report will be out of sync with what's actually in my ledger. I can't illustrate any better than that. One of the major reasons that these inventories get out of balance is because the effects of the non-inventory type items having an inventory account associated with them. All right? So don't do that. Cost reports line up with inventory postings. So here's your inventory value report. Now, again, these are different reports, but I'm going to suggest to you in a properly structured inventory, we can in fact tie this to the closing balance on the ledger. But here's some of the things I want to make sure you understand. More complex this structure is, the harder it is to reconcile to here. So let me talk about what a reconciliation needs to look like. If you're going to do a reconciliation and try to tie it to a closing balance or an inventory balance in a ledger, you need to make sure that you've incorporated all the accounts that are inventory. And let me illustrate what that means. I find that adding physical and financial together is the most effective way to tie to an inventory balance. It doesn't have to be that way, but let's talk about some of the accounts. Obviously, you have like your raw material and finished goods accounts, inventory accounts. But also, do you have separate accounts that are set up for the receipt versus the financial closing of that? And let me illustrate. If you have an account like a purchases received but not vouchered or something like that, in other words, a different ledger account that's hit than is hit when we post the vendor invoice, and this happens a lot, you need to incorporate that in your settlements, because that is a different account. So you need to add that in, because if you look at an inventory value report, those quantities are going to show up in there. Now you can segregate them by physical versus financial, or you can add them up together, but that means you've got to add the account together. And also, if they're not in the same granularity as your raw materials and finished goods, what you're going to end up with is you're going to have a hard time to reconcile raw materials if part of that receipt, or you received but not invoiced, or whatever you might want to call that account, is not broken into those inventory breakdowns. So just so you know, I don't see a great value, in my opinion, with separating those accounts. Again, I don't see any great value in doing that. That's how a lot of people set them up. But when it comes in its inventory, it has a footprint in inventory. It has a footprint in your inventory value report. I don't see a great deal of reason to separate those. Like here is accounts receivable not invoiced. Well, I'm not sure exactly what they're doing. You know, sometimes these examples aren't very good when we look at the demo stuff. But I think you know what I'm talking about, is where it's the same thing where I've shipped it, but I haven't invoiced it. That's usually a short period of time, so it's not a real big deal. The only advantage I can see by having those accounts is it gives you an idea of what's out there on the AP side, what's in your accrual that you haven't processed a vendor invoice. That's fine as long as you keep it small, you keep it managed, and you understand what it represents. There's also no problem with having that hit the raw materials inventory account and the first time, reversing itself out and reposting with changes to the financial value. I don't see a huge problem with that, and it makes it actually easier to reconcile, because I usually add the physical and financial value together. But if you're having trouble reconciling, everybody does. It's just a matter of understanding how you're posting, understanding where your leaks are, and then really trying to bring them together over time. So a lot of times what I'll do is, once I'm satisfied that the inventory really is set up properly, I'll usually understand what the adjustment needs to be. I'll either make that adjustment or track it to see if it's getting worse. And if so, how much worse? In theory, if I fixed everything period to period, The difference should be what's in that balance, that variance that I've identified earlier in the process. But at some point in time, you're going to want to tie those two together when you fix them. The problem that most people have is they're chasing it. They'll fix it, the next period they've got to fix it again, the next period again. Pretty soon it's a question of what's right and what's wrong. All right? Here's another pet peeve of mine. All accounts that are associated with some area of the system should be locked down. Let me illustrate. Inventory accounts, they should be locked down. You should not be able to hit an inventory account from the general ledger unless you're doing it to adjust inventory to match up with the physical inventory. But don't leave it open, and people do that. Same thing with AR, same thing with AP. You shouldn't necessarily be, and let me qualify what I mean by general ledger. What I'm suggesting is that you should not be able to hit the ledger account from the general journal. You clearly can hit it from the customer account level in AR, let's say. But there is nothing in general journal that you should do to adjust inventory. That should be all done in inventory ledgers, unless it's to fix a balance. Time after time, these are left open. If you have a process that you adjust inventory through the ledger for any other reason, I would question that. If you have other types of inventory accounts that you want to be able to adjust, set up another inventory account, make the adjustment to that, then apply that adjustment through your reporting process to your ledger. Never do ledger adjustments to an inventory account, in other words. Again, it's less it's to tie a balance together. Okay, so now we're going to talk about, we've kind of talked and generalized what the problems you identify, but now let's talk about what are the steps that we really need to think about to fix this. Okay. Okay, the first one you're saying, put a stake in the ground, right? You need to say, how big is my variability between the value report and my ledger balances? Have a way to kind of be able to tie that report. And there's different ways you can do it by setting up the value report to report certain segments of inventory. At the end of the day, though, what you want to do is be able to calculate the difference between what's in the value report and what the ledger balances are. Then what you've got to do is you've got to get compliance. This has to be a process that we're going to say, look, when you are using this system, you need to post reliably. And one of the things that includes is the posting of vendor invoices, production orders. You have to get whoever's posting those to have compliance. If you have a ledger out there that's not posted, there's a problem, because every ledger should end up being posted every month. So if you've issued materials to a production order, it should be posted. Any one of these you don't post can force things out of balance. Fix your model groups. Okay, keep it from happening. Run the open quantity report. That's going to give you things that are out in the past that you need to deal with. And by the way, this is not simple sometimes, and I understand that. But there are ways you can get around it and adjust back out the effects. But you've got to, at some point, get rid of these open quantities. And I can't tell you the best way to do it because everyone is different. But at the end of the day, as long as you can get rid of those open quantities, I'll give you another example that forces out of inventory. when you do and you may not do it, when you pick an item or when you register an item, those are transactions that can force your inventory reporting out of balance also. Because now you have a transaction out there and you may not have any inventory to support it. Let me illustrate. I've seen many times where I've seen people have, let's say, 100 items reserved, or I mean registered, excuse me. The two terms are so close. But let's say I've got 100 registered to a location. Then they go in and cycle count that location. I still have 100 reserved, but I have now 0 quantity that reflects the reservation. The inventory looks as that as a negative inventory value because I've got 100 registered that no longer exist. And just a thing on cycle counting, you got to know what you're doing. You can cause more problems with cycle counting than you fix by not knowing what you're doing. And to illustrate, people, if you don't have timely inventory transactions, and let me give you an idea of exactly what happens. Let's say I have inventory out there and I cycle count. And I cycle count now to reflect 10. It was showing 0, but I cycle counted 10. And I haven't posted my PO receipts yet. Now, next day, I post my PO receipts for 10. What would my inventory be now if I cycle counted in 10, and then the next day I did a PO receipt for 10? There must be something wrong with my screen. I'm not getting anything in the questions. Okay, there we go. Absolutely, it's 20. So what I've done now is by the timeliness and the change of my cycle counting and transactions, I've now went to fixing what we thought was the 10 I physically have on hand. And then the next day it goes out of balance because the 10 that I should have received through the computer is now 10 more it adds. So now my inventory went from 0 to 20 and I have 10 on hand. So what I'm trying to illustrate is that you must be able to transact everything within the same day for something like cycle counting to work. It's the same thing with work in process. People try to count work in process. Well, was it issued or was it not issued to the production order? If it's been issued to the production order, it's in the production order. If you count it, now you're saying we have more inventory of that raw material than we actually have. Make sense? So counting WIP is something you should really understand. And I'm going to suggest you most of the time trying to cycle count WIP, unless you have a very disciplined way of moving it from an inventory to a in production construct, doesn't work. Okay, check inventory prices. We've talked about that. That's where I'm comparing to the planned cost and getting out the outliers of transactions that are outside whatever that percentage I said. And by the way, in fixing, I start with a fairly large difference, and then as I go on, I make the margin smaller or the percentage smaller, because what you're really looking to do is to identify the large variability, and then as you get smaller and smaller, it's less important on smaller dollar items. Not that it's not important, it's less important than on larger dollar items. So I just make it so that I have a larger variability I'm looking for. I might start at 50, anything over 50%. I may end up with anything over 20% I want to look at, is kind of the idea. You obviously have to do your inventory calculations and recalculations on a regular basis. And then the other thing is monitor settlements and start with the largest first. The largest first will have the largest impact. So start with the largest. You're not going to fix all of them in one period, is kind of the idea. Fix inventory groups. Again, we're showing here in the posting accounts that this inventory group audio is hitting an inventory account. Here I go down here, I'm reviewing the product setups. I've got a service item, and this the easiest way I know to do it is get the product type, verify the item group is against a service item group. In other words, expensing at the time of issue. Open quantities and check cost price reports. Here's a check open quantities reports. What this is saying is these are items that are out here from a long time ago. Notice how we've got these two out here that are showing registered. If we cycle counted those out, that would be giving you an inventory balance. So we're seeing things, if it shows up on here, by the way, this is an older system. The newer system I have, it doesn't have as robust of information that the 2012 had. So sometimes I get, and also, by the way, what happened is I had a problem with my 365 F&O systems, and I had to repost those. So some of my examples, but again, I think we've pretty much covered, still pretty good on everything. But you can see a lot of these are registered, and nobody's ever done anything with them, is the example here. And then you can see where they're received, but there was never a vendor invoice. So this report gives you an idea how bad it is. And here's your cost prices. You can see I'm saying anything over 50% deviation I want to see. And I'm basing it on the item cost price. The item cost price is the planned cost. And here's giving you some examples here of those things that here it received at 0 for purchase order, and it should have been 8, or wait a minute, what are we saying here? Oh, right, here's where the unit cost is 0. This says receive 8 at 99, but I have no planned cost. Here, you've got the deviation of 100% because it has a planned cost and it was received at 0, if that makes sense to you. Okay, so you're getting both. It's telling you any place you don't have a planned cost, and then it's saying what is the percentage deviation between what it transacted, because here's what it's looking at. The planned cost is 16, but it was received at 0. Okay, so now we're going to go through and look at settlements. Settlements is what I look at. By the way, I had a question. Yeah, let me tell you the breadcrumbs. Carol, I believe that in 2012, they don't break out these reports separately. The way to get to it in 2012, it should be an inventory warehouse. There is a periodic, it should be in periodic processes. You must go through and start the inventory close, and both reports are available there. But you never have to complete the inventory close, all right? So you just go and you open those up, and then your reports are there, and then you can just run the reports without performing the close. And I would recommend somewhere mid-period, run those reports. That gives you an opportunity, particularly the one where you've got the deviation of 50%. You might have an opportunity to fix it, whether it's through an adjustment or whatever. You might have an opportunity to fix it before you do the inventory close. There's one thing that's very important. Provided it's financially processed in both sides, and it's more likely to happen on a cycle count or a production order than it is on a purchase order, because you typically have this thing called a vendor invoice that comes in. that reestablishes if you've done something wrong on the physical side, what the financial costs would be. So you have that reconciliation of production order. You don't necessarily, because if you close it without posting any cost to it, and you end it and you override, you could in fact in production order easily have posted it at zero. Once it's financially settled, it's eligible to be, or once it's financially settled on the production side, if it's financial settled on the issue side, you're not going to get that back once it closes. You'll have to make some manner of adjustment to the ledger at that point, but you're not going to be able to fix it through this process. So be particularly aware of the fact on production orders to make sure you have proper production costing coming out of here. So let's talk about the settlements. Okay, on-hand adjustment. What we've done here effectively said our on-hand is not correct, so we've adjusted it to reflect what our planned cost is. Because our inventory was transacted improperly, but now we want to fix our on-hand. So I'm suggesting to you this on-hand adjustment here, you created a $20,000 settlement, which is reflected in here. Okay, it's reflected against a couple purchase order. So again, what I'm talking about, when you look at settlements, sort the largest and start there. Right? So why did this happen? And so I usually start by, I would go down to about here initially and going through and reconcile. It depends on how many these are, but at the end of the day, what I'm really trying to say is start with the largest. A settlement or adjustment is, again, usually an indication of something that is different than what the anticipated financial impact's going to be. So if I think I'm paying 13 and the vendor charges me 17, first off, I don't know why that would happen that way, but of course it does. See, in my opinion, I would make, if I was the vendor, I want you to fix your purchase order to reflect what I'm going to bill you. But you can see now, if I start with the larger adjustment, I'm going to show you other adjustments. Start with the other adjustments and say, what caused this? In this case, I believe it might have been something like, well, the purchase order was zero. It could have been something like that. But I think you get the idea, right? Recalculation. Again, we don't have any big ones here, but if you had big adjustments, why did that happen? Remember, the recalculation is to make up for the financial ending situation with what occurred before that happens. In other words, a sales order, something was sold before the vendor invoice came in. Something was sold before we ended the production order. The bigger that adjustment, in the production order, your standards are not right. There was something wrong with that production order, or that's pretty much the main things. So we're not issuing our materials, or something we're doing incorrectly. The other thing would be on the purchase order side, what the vendor's charging is for us is not what we've agreed to pay on that. Keep in mind, there can be some settlements, we're going to cover them later, that can be occurred by after the fact freight adjustments. And we're going to talk about that. So I've got this new screen over here that I look at now, every now and again. So inventory transactions. You could be going through inventory transactions. Open it up to see your adjustment. I mean, the easiest way to see these adjustments is because many times people are looking at their inventory transactions. Personalize it and add the adjustment field. Also, I like to add the physical cost if it's not there, the cost amount, this is the financial cost, and the adjustment. In other words, you can have different views whether you're looking at it from the costing standpoint than when you're looking from the inventory standpoint. The costing, I don't necessarily care what location it is, right? But I probably care what site it is. But so you get the idea. But the first thing is it occurring? And then I can go down into more detail. So be a student of how your costing system is working by looking at it at this level of detail. You also can tell when you fixed it, by the way. You could look at history and say, look, we were making a $10,000 adjustment, and here is where we started to, the adjustments went way down. So that can be an indication we fixed it. Just keep in mind, the adjustment's going to stay out there once you financially close. So that adjustment is fixed. It did fix something, so it's not wrong. It's just that the smaller adjustments you see, the better you're working to the actual. I wanted to cover this because it kind of touches on two subjects. I want to talk about miscellaneous charges real quick, how they add to your fully built up costs, and then also adjustments, and this specifically is adjustment that can be made after the fact. So I want to suggest to you that freight charges after the fact will create a settlement or adjustment. So let me paint the picture as what we're doing here. First off, on charge codes. There's two ways I typically work with well, there's actually two main ways I work with charge codes. There's the known, and then there's the accrued for. So if the vendor freight is on the vendor invoice, I would have a charge code that says, hit the item on one side and hit the vendor on the other side. This is more an accrual setup. What I'm saying is that for vendor freight, I'm going to accrue and hit a ledger account, order freight on one side, and the item on the other. So what I'm saying is when I post this ledger account, when I post this accrual, it's the vendor didn't charge me for it. So I'm going to hit an order freight, or it could be an incoming freight or something like that. The offset is an item. So really what I'm saying is whatever this freight amount was, let's say it's $100, it's going to add $100 to the item value. And I want to suggest to you, it only does that either through the adjustment process I'm going to show you, or when the vendor invoice posts. It will not do it when the physical invoice. So even if I'm accruing for freight, I can add that to the plan cost, or the plan cost, or the standard cost. And there's other methods if you're 20, and this is in a different session. I'll cover this, but I just want you to be aware of your freight charge can, in fact, hit the value of your item based on this setup and not impact what you're paying the vendor, because I've offset it to be this other account. Now, excuse me a second. Okay, what I'm showing here now, and a lot of people don't know this, but, and also it's how it's implemented is a little bit, I'm not real happy with, but here's the key. I now have, this is an invoice journal from this vendor. Here's a purchase order. Now this has already been vouchered, so I've already gotten the vendor invoice. Now I get the freight bill. Keep in mind, I could have been using a third party or an independent freight company. I want to allocate freight charges to this invoice line. Clearly it's done after the fact. And one thing I want to suggest to you, if the inventory had been physically closed, or, had been closed, you wouldn't be able to make this adjustment. But what we're saying, or a little more qualified, no, I don't believe I'd be able to make it, because if we inventory close both sides, there's no place to put it. But anyway, let's go through, and you'll notice here, I could look at the original charges, or I can do what's called an adjustment. So think of when I look at a freight adjustment, it's normally a third-party freight that I've went through and says, I apportion this. And by the way, this is the only way to do it if you don't accrue for it, or you can't do it in such a way that you can do it during the vendor invoicing time. And I don't think you want to wait. Freight charges on third parties take a longer time to reconcile, and you don't want to keep things open while you're doing it. So here's what I'm trying to illustrate. I now have a third-party freight bill come in. I need to apportion part of that freight to this vendor invoice process. Is what I'm saying here makes sense to everybody? Okay, great. So now I'm trying to, I had to have a way in this system, and I know you could do it in 2012. I'm not sure what you did in 2009. It's been a long time since I worked on a 2009 system, and I go back to version 3. But a little 2.5. But in general, though, we needed a way to say we wanted to add this to the value of inventory. Okay, so what we're doing here then is what this has what you'll see. When you hit this screen will come up. So what I put is $1,000 in charges here. And fixed means that it's $1,000, not a percentage or whatever. So I've said the freight was $1,000 that I need to allocate to the inventory. That will show us a adjustment in the transaction. Let me do something here that's very important, though. If I went back into here or here, I would not see anything. So I want you to know that once the adjustment is made, it kind of disappears. And I don't like that, because I would think that you should be able to, but you can't. You can't see it from here. This was charges on the original purchase order. These are adjustments, and the adjustment kind of disappears at that point. But you can see it in your transaction set. You can see it in the transaction itself. You'll notice that the physical cost now, it went from $20,000 to $21,000 cost amount. Now that's just on that inventory transaction right now. Now, if you look at freight adjustments, and from this screen, and actually this screen is actually the transaction, the PO transaction. So this should be changed to PO transaction. Sorry about that. But if I click on settlements, I can see that. And there's a space in accounts payable where it basically has an adjustment voucher. I used to keep it in here, but the bottom line is it's a voucher. It creates this voucher number, and this voucher number comes from a voucher setup on the different number sequences. So I can see it here in that settlement there. Another thing I can see it is when I do the settlements for this voucher. In other words, this is basically doing like a recalculation. So it's now applying that adjustment to the sales order that it got sold on. So what we did is added that added to the value of inventory $1,000. Now I'm going to add that $1,000 to the cost of goods sold to the sales order that was originally received, that was sold against that receipt. Okay? So again, going back to it, after the fact, I said there was $1,000 in freight. That $1,000, by the way, it will impact your inventory transactions coming in. When I do my recalculation, it will in fact then apply that to the cost of goods sold. Very important. Very important. So that freight adjustment, what I'm showing you is that adjustment is an adjustment we want to account for. My belief is that we should have some understanding, and it probably is in another session, but we should have some understanding of what the freight should be and put in an accrual. And we can expand upon that later, but what I'm trying to tell you now is that freight adjustments, this is how they get into the system. Now, I don't know how many people are using the transportation system. You know, a lot of people use the WMS, not too many are using the TMS. There is a facility for applying these, but it's fairly complex. I don't know too many people are using it, but you have to be able to set up what orders are going to come in on what freight bill. And so you can allocate it that way. I don't know too many people are doing it. It might be something you look at some point in time, but it means that you have to have an incoming receipts structure to be able to do that. You have to say what orders are coming in on what supply side planning. Okay, transaction adjustments. Those are where we've done the same thing. We've done adjustments. So we kind of covered adjustments the last time, but what we're saying here is that if I do an adjustment means I have financially settled the supply side. I can then just adjust those incoming transactions to reflect the cost it should have been, and that will get reflected then in the purchase order, sales order combinations. All right? So again, an adjustment is something I'm adjusting after the physical transaction or financial transaction has been completed on something like a more likely it's done on a production order. It's where a production order I received out at the wrong cost, I've ended it. This allows me to change the value of that inventory, which will in turn affect the things like cost of goods sold downstream. Again, that's why it's so vital to get this earlier in the process, because if I could do this adjustment before the inventory close, I actually then can have a good cost of goods sold during that period. How to avoid the most common mistakes, and I think we're pretty good on time. Again, just this is more of a summary. Need a plan cost. Need a price on purchase orders. You need to end production orders within the period complete with the cost. You need to get your items set up correctly. You need to have consistent and thorough closing and recalculation processes. You need to, again, set up items and posting to inventory account. Oh, what we're saying is posting into inventory accounts other than an inventory transaction, like a ledger adjusting the inventory account. Also, we talked about the work in process, counting work in process rather than not knowing what the status of work in process is. And then cost roll-ups, which establish a planned cost, and then it uses that cost, and also that's what it uses when it's looking at an estimated cost within a production order. Those are the things that you need to think about shoring up. Recommendations. Always have a planned cost. Purchase orders should represent what the vendor invoice is going to charge you. Make sure all your journals are posted on a production order, and make sure you understand the end process and how you can make it so that it is inclusive of things and warning you on things that were not properly closed. Fix the items, all right? By the way, most problems occur after the implementation because we've had more scrutiny over all the items to try to get them aligned properly. you need to spend time and have good work processes on service items versus regular items. Okay, needs to be started. Closing needs to be part of your standard month-end process. Lock down your inventory accounts. Understand the difference between WIP and inventory. They're not the same. And let me illustrate. Many times I have people that use the WIP account for an item that's in inventory and an item that is in production. WIP should be, and I don't care what else you call it other than WIP. I like to use the term semi-finished goods, but WIP should be that value of material that's internal to a production process. In other words, what happens is you credit inventory, debit WIP when you issue materials into a production order. So WIP is the value of that material within a production order. You really can't count that very easily. There are ways you can kind of do it, but all I'm really saying is start using the term of semi-finished good, which means a material that's come out of production order that has a value added to it that can in fact be issued to an upstream production order. That should be a different ledger designation than WIP itself. That's the point I'm trying to make. Cost roll-up should be representative of what the cost is. And then always be cognizant of your difference between your inventory value and ledger. Okay, and we got to start by understanding the differences and then try to monitor what the delta is. Because if you're getting huge swings back and forth, that's a good indication that you've got some things that are set up wrong, and just doing an adjustment isn't going to help you. You've got to get to the source of the problem. One other thing too that I didn't mention that I look at when I go in to try to fix inventory problems, what is the value of cycle counts? If I'm getting cycle counts that represent $1 million each way, people aren't using the system. Or they're certainly not using the system correctly. When I do inventory adjustments, that is an indication of poor execution. Unless it's for some reason such as, let's say I'm issuing it for destructive testing or something, some other reason. But generally, it's an indication that people aren't properly using the system, okay? Also, you got to have somebody responsible for cost. It's not automatic, okay? I also believe that not understanding what your costs are is one of the single biggest reasons why companies fail. Sometimes it's the order you don't take that's more important than the order you do take. And if you're taking orders in a competitive environment without understanding what your cost is, you typically are basically putting your business at risk. There are clients and opportunities that nobody should want. Is what it boils down to. Okay, right. You got to hold cost accounting responsible for the outcomes, at least from the standpoint of understanding the inventory, the end of production orders, so that they can make sure that even though it's not their responsibility to post those issues and things like that, somebody has to say this is wrong, we need to fix it. And that needs to be forced back up to the people. And I understand sometimes that's a hopeless situation, but those need to be pushed back to get better on the execution side. If they're not going to get better on the execution side and transaction side, you're never going to get there. Again, we need to execute to a workable process is really what it boils down to. This isn't you didn't do your job. How can we do the job better? And that's all part of the team building concept. As soon as you say you're not doing your job, the last thing they're going to do is their job or the job you want them to do. So work at it as a team and make it a team concept. If you do not have support from the top in trying to execute properly running costing inventory systems, you're not going to be successful. You cannot have authority without or you cannot have responsibility without authority, because there's so many things you can't control. So you got to have a team, and it's got to be something the company wants to do, because if it doesn't come from the company down, one person can't fix this. It has to be a team effort. We talked about the separating the inventory to multiple accounts. Semi-finished, finished. I know we're getting closer to the end. Never post directly in inventory accounts. We're saying if you have inventory that's part of the ledger but not in AX, make sure it's a separate account. Work towards permanent fixes. Also consider your item group as a financial dimension. Okay, this allows you to it's easier to reconcile your inventory, quite frankly. Because think about it, if I have a dimension that says this part of my inventory is audio, I have a point of reconciliation that I can tie to that item group. So consider that. Also, it allows you to get a P&L based on product group. It's a big advantage. To me, it's a big advantage. That probably is for another session, but just so you know, that's an idea you can think about. Some of this, I guess, is redundant, but again, take time to understand what it's doing. Don't get behind the curve. Don't think you can fix everything in one period. Don't wait to the end of the period to see where your problems are. Always look for places you don't have planned cost. Run recalculations on a regular basis if you're on an actual cost system. All the same thing, look at check cost prices on a regular basis. Manage by variance, manage by settlements, and understand your timing to understand how the problems occur. We've kind of covered this in previous sessions on how these are impacted. Again, this is from previous stuff, but not every attendant. Remember that no inventory hand, no cost. Also keep in mind that it operates in weighted average date, that things like LIFO and FIFO are adjustments that occur during recalculation. You are transacting at average weighted date during the rest of the time. So you look at it right now, it's average weighted date. If you've got things that never financially close, this is something wrong you need to look at. And start with the biggest adjustments. And I'll just touch on this again. Your biggest variability comes from manufactured items, so you need to be on top of it. That should have been end. It's easier to fix it before you end the production order. Consider a tolerance for acceptable variability on your items. Make sure your journals are posted, maintain proper standards, and improve your procedures. Need oversight? Again, identify before the production are closed. Don't span more than the period. I could probably summarize some of this, but you know, try to make standard improvements, and also batch orders consider co-products and byproducts. So, and then I want to touch on this, and then I'm going to jump over just for a minute to talk about something we want to do in the future. Okay, it's important to understand the profitability by the item in a group. And that means you've got to better understand the true cost, and because understanding the true stop is the first step towards improving them. If you don't understand your cost, it's kind of hard to make decisions. And to do that, you better understand where your true profits are coming from. And really, it's vital to a company to understand what their costs are. Okay? So I just want to open up something else. And I'm just going to spend a couple minutes going over it, not to any great extent. Julie and I are talking about, this was the 5th piece in this presentation. We originally started with 4, but we can look at, I'd like to hear from you what your interests are, and we're talking about setting up a 5th session, that we'll do this plus addressing some of the questions that occurred through the rest of the seminars. A lot were based on this. What this is about is really talking about understanding the components of cost, miscellaneous charges as an allocation, looking at the costing allocation of purchase items in 2012 and beyond. This is a 2012 presentation, by the way, which will update to F&O. Allocation of warehouse operations to item cost, best practice managing freight costs. This is a pretty good subject, and I just wanted to give you an idea what it's involved in. Okay, it's talking about what your cost of inventory are that you need to consider in addressing a fully built-up cost. Cost of transportation, what are they? What do we need to do about them? What are the components of cost that we need to track? You know, what are the things that can affect the cost of goods for resale? Discounts, rebates, cash discounts, commissions. Those are all things that affect your cost. So we want to go through the manufacturer. I'm going through this not to do a presentation, but just to give you an idea what can be in this presentation. So benefits, and then we go in and we go into details and say, what are miscellaneous charges? How are they structured? You know, what are the charge groups? How do you set them up? To do accruals, what are automated charges? So what I want to end with, and I'm right at the, I'm 1 minute over, is this is something we can do for the future if somebody is really interested in what we call is how to attain a fully built up cost. Okay.
All right.
Any questions?
Thank you so much, John. You have one question in the, well, a couple comments in the queue there.
Mm-hmm. Yeah, what we're possibly, and Julie, I know we talked about it a little bit, we're thinking about maybe doing a 5th session in November with that, and because I think this is one where we were originally talked about doing 4 sessions, so I had to pick up which 4, and I thought the first 4 kind of segued into, because all the stuff build up to the last one, but this is one that I actually teach quite a bit too. So, okay. And what we'll do then is, let me answer the one on carrying. Okay, let's see. I'm going to get down. What about carrying cost? Carrying costs are interesting because what carrying costs are kind of, see, we've got the cost of acquisition cost. Carrying costs go into all the things that cost you to support that. And let's talk about what that is. Warehouse space. There are, let's say, resources to move materials, resources to count materials, all those types of things. It is questionable as to how much you can allocate, but how we usually do that is, if we want to reflect for carrying cost, we do that typically through an allocation method, is what we'll do on the front end of the receipt, because that's the only transactional time we can get to allocate that carrying cost. So if you look at it, the value of your inventory is inclusive of carrying cost. So when you look at your value of inventory, one of the things you want to do, the thing you do to combat carrying cost is you turn your inventory. So you allocate it on the front end, but the less inventory you have or the more inventory turns you have, the less the impact of carrying cost. Keep in mind that can be broken out on some of the newer versions of AX as its own element too. So I hope that answered that question, but that's kind of what I look at it. Okay, let me look at some of the other questions. Yeah, we talked about the check door. Oh, hold on, let me scroll down here. I should probably move this over so you can see where. Okay, so there's carrying cost. I think there seems to be interest, so we can probably schedule that. And certainly anyone who's attended, we should be able to, Julie, we can easily get whoever's attended that information, right, for the 5th session?
Absolutely, yep.
Okay, so, okay, the next question, let me move the questions over now. I don't know how well you can see them, but let's move them over. Nope, you can't see them there very well, can you?
No, I don't think they'll be able to see the question.
Okay, well, here's what we're doing, okay? What would you suggest to fix a PO that used the price unit 1 instead of 1,000, meaning the purchase cost 1,000 times more than it should be? Ricardo, it depends on where you're at in the process. Keep in mind that you can always go in and change the purchase order and it will reflect correctly from that point forward. Now, you can also consider adjustments, but if it hasn't been financially settled, your adjustment's going to occur when you actually get the vendor invoice. So if you haven't posted the vendor invoice yet, I would suggest that you can go ahead and understand that if you fix the purchase order, you're not going to fix the receipt necessarily. You also keep in mind you can return against that purchase order and then go ahead and change it and return it even against another line. In other words, once you've financially invoiced it for it, the best way to fix it is through an adjustment. So you would have to adjust your inventory if you're saying, well, if it costs 1,000 times more, do it through an adjustment process, okay, for that item. And that's how you'd fix that, because you can't fix effectively within the purchase order anymore. You've got to fix it outside the purchase order, and that's called an adjustment, okay? And we did cover the setup, but I'll consider doing a brief thing on the setup, but we did cover in an early session. Okay, wait for the next session, sounds good. Yeah, okay. And we're certainly talking about inventory, and I'd also like you to consider, Julie, been doing some manufacturing sessions too.
We certainly could talk about that. We should probably go to the last one from Ala and then call it good there.
Okay. Yes, and project item transactions, I'm going to suggest I'll be out at AXUG, but if you have interest in more project, I teach a lot of the project tasks. I actually worked in construction job costing and general contracting systems earlier in my career, and I've worked a lot with the AX project module. It's just there doesn't seem as much demand for the other areas, but clearly, yes, we'll be more than happy to do some project, and particularly when it comes to the actual accounting postings, because that is very difficult. And then also how the estimation process runs, because quite frankly, the body of knowledge on projects hasn't been very good historically. So I've worked with it quite a bit. So those are some other things. But what your responses are and what you requests from the users group are how we focus what our efforts are. Okay? All right.
Absolutely. I want to thank you so much, Don. You need to rest your voice now.
Well, I don't have too long to rest. So,
Absolutely.
October is going to be here before you know it.
It
right?
is, that's for certain. So I want to thank you very, very much, and thank you all for joining as well. And with that, I'll close the webinar and stop the recording. Have a great week, everyone.
Okay, don't be a stranger. Have a good weekend.